Q2 bank earnings kick off Thursday with JP Morgan and Morgan Stanley reporting before the bell. The stocks have been under pressure for most of the year, but our next guest thinks bad news is priced into the results. Jeff Harte is managing director, senior research analyst at Piper Sandler. Jeff, good to see you. We were just talking about guidance. What's your sense of how, since the quarter closed, what the environment has been like for banks? What do you think their guidance is going to sound like?
I think we get two things out of the guidance, and it's kind of what we've been getting a lot of the last recent quarters. One, net interest income, they're probably going to guide higher again. I mean, I think the street's generally being conservative on interest income, just kind of to play it safe. And then the second leg is going to be credit. I think we're going to get, no problems in the credit front yet. Unfortunately, what investors are really going to be looking for is a little further look up at the windshield as opposed to through the review mirror of what the quarter was like. Specifically, how bad can credit get and when's it going to get there is going to be one of the big focal points for investors. I'm not sure that we're going to get, much for answers from management yet on that one.
Jeff, we talk a lot about the yield curve inverting. Does it make that big of a difference? Is that something you're watching in terms of your forecast for a lot of these names?
Not so much so. I mean, what the big difference is it, it tends to forecast a recession. And look, banks provide the lubrication that makes the economy work. So, I mean, you have to have a macro view. And if your macro view is a tough recession coming, banks are going to be a tough place to be. But we do tend to look a little more at the 6-month, 5-year yield curve as opposed to the standard 2-year, 10-year. It gives you a little bit of kind of picture of how it affects the banks. And that's flattened quite a bit recently as well, but it's still kind of sitting at least in a better shape than that 2-year, 10-year.
Hey, Jeff, it's Tim. Interesting plant over your shoulder, by the way. The question I have in terms of a breakdown between regional and money center banks is one better prepared to weather this period? And I think from a credit perspective, potential losses and whatnot, I think I know the answer. But is there a way you would be tactical in this period as you look at the entire sector?
Yeah, I mean, as we look at it now, what we know is traditional banking is still really strong, whereas investment banking is kind of a little weaker. We'll see how that plays out going forward. But I still tend to be in the camp of liking the money center banks, right? The large cap players for two reasons. One, they've got scale, and it matters more than ever now. So if we are in a really tough economic environment, they've got the scale to defend the bottom line while still investing in things like marketing and technology to kind of gain some market share. But the second part, though, is really what we've seen from credit so far. I mean, especially like credit cards, right? You look at B of A, JP Morgan, and Citigroup, their credit card delinquencies on a monthly basis are still going down. That's not what we're seeing for the credit card, industry in general. So I think we're actually seeing some of the better kind of credit underwriting from some of the big banks, which is a bit unusual for maybe what we've always seen in the past.
Jeff, it's Karen. Thanks so much for being on. So to that point about credit, do you think then that they should be proactively conservative and say, all right, even though we're not seeing it right now, let's take some reserves because if the economy slows down, we're going to see a tick up in credit losses?
I think so. I mean, I would like to see that. I don't know if we will, because it is still somewhat formulaic as to how they have to arrive at the reserves to put up. So I think, we're kind of hitting, if not hit the end of reserve releases, and that's going to be a matter of how much do they build them. But I mean, JP Morgan kind of sets the tone kind of when they come out. And I think if they were to come out and start more meaningfully building reserves, that would be viewed positively because it would kind of show that they're prepared and, the market thinks that's coming. I think as you look forward, one of the pushbacks I get from investors on the space is kind of the consensus estimate still has credit losses, somewhere less than they were in 2018, 2019 pre-COVID. I think the investors thinking out there is it's got to be higher than that, potentially meaningfully higher than that before, it accurately reflected. So unlike kind of you go back to the fourth quarter in January and JP Morgan came out and said, expenses are going up, the stock got hit pretty hard. I think if they were to lead off with some reserve bills, that might actually be well received by the market.
Jeff, good to speak with you. Thank you.
Good to be on. Good night.
Jeff Harte of Sandler. Potential upside, he says, for Goldman Sachs and Morgan Stanley. Guy, I think you're in that camp.
No, and I think we talked about Goldman Sachs a few weeks ago. They could trade their way out of this quarter. I don't know if the street's going to reward them, but I thought the stock would rally in earnings. But JP Morgan, to me, sets up the best. I'm sure Karen would echo this. 35% peak to trough decline since October. Probably about as cheap as you're going to get in terms of price to book that we've seen in quite some time. And I think you're going to see a relief rally in the name, which may take the broader market higher as well.
I mean, to Jeff's point, you probably want to see banks take reserves. in this
I think so. He did make an interesting point, which is they can't just be overly conservative.
Right.
They are. It's a tightly, regulated thing how much you can reserve. But I think it would be good if they could push it a little.
Yeah, Steve.
I can't buy banks going into what I think is going to be a recession, whether it's shallow, garden variety, or anything, or all of the above. You're going to have less small business loans, less mortgages, less trading profits, less business and economic activity. All of them are down 20 to 30% year to date, all the majors. Well, the odd thing is Wells Fargo has outperformed on a relative basis. If you're going to buy a bank, I'd buy Wells Fargo, as silly as that sounds coming out of my mouth.
I was going to say it does sound kind of. I mean, Tim, what do you think of that strategy?
Well, I look at some of the money center banks and I look at their commercial loan growth, but more importantly, I look at higher rates. And these banks haven't had rates here in how long? I mean, the profitability that people are not really expecting with companies banks that have balance sheets that have never been better, et cetera. So sure, Jamie Dimon talks about storms. So you have to prepare for storms. You have to put some money aside. But I think you have a dynamic where the profitability of the banks is underappreciated here. What kind of recession we have? Not sure. Have we priced it in? Not sure. Feel like we priced in a lot. And again, if you look to peak to trough drawdowns, the guy references, these are the type that we've seen through much nastier periods. I think we're all highlighting concerns around credit. And that's the big unknown here. I don't think people are going to have banks get away from them. But I think if you're an investor and you're picking some of these names, and I think Bank of America sets up better on valuation, I think you have opportunities here.